All right. All right. Welcome to Principles of Auditing. And first, we want to talk about the role of the public accountant in the American economy. Now, public accountant meaning CPA. So that's really the focus of this chapter. It assumes that those studying it want to become CPAs. You may not, but you know, just because you don't want to be a CPA right now doesn't mean you might not later. What you will find out is that you'll get out there in the working world and realize that you could do a lot more things and probably have a lot better income possibilities if you have a CPA versus not having a CPA. And that's it, even if you have like a CMA, CIA, and all these other things that you can get. All right, so CPAs provide assurance services, and that's kind of the broad term used to describe the work that CPAs do. And so these are a broad range of information enhancement services that are performed by the CPA. And what they're done is to provide the reliability of the information. You know, you're an intermediary between the investing and lending public and the companies. And so you increase the reliability of the information and you put the information into a form or context that facilitates decision making. Do I want to invest in this stock? Do I want to lend this company money? Are they credit worthy? Now, types of assurance services mainly are attestation services. And so there are different types of attestation services, the main one being the audit of financial statements. But you could also have either an audit and examination or terms that are used interchangeably. So if you see the term examination as they have here, it's the same as an audit. But there are other types of attestation services. You could have a review of financial statements. It's less stringent, thus less assurance that the users have as to its accuracy. And then you have something called agreed upon procedures. And so that's not a big part of this chapter. It's mainly the audit or examination that we'll be focusing on. So bottom line is an audit is an assurance services. You're providing assurance to the users of this financial information. You can also have attestation services related to internal controls. And as a matter of fact, for public companies, under Sarbanes-Oxley, public companies are now required not only to have their financial statements audited, but they're also required to have the CPA firm that they hire to do the audit services. They're also required to render an opinion on the effectiveness of the company's internal controls. So that too is an attestation services or service. Now, on top of assurance services, one of which is attestation services that the CPA provides. The CPA firm could also provide other types of what they call non-assurance services, tax services, management consulting services, financial planning services, things like that. And so when you're providing attestation services, you're just simply attesting to the fact that the information provided by the company is reliable. Now, does that mean that you are a guarantor that the information provided by the company is absolutely correct? No, you're not a guarantor of results. And so we'll get into that at some point, but just realize that's not what you're doing. But you're engaged to issue an opinion based upon your examination, if that's what you're doing. But you're also doing that in a review or agreed upon procedure. Now, the opinion you give or the assurance you give is a little different depending on whether or not you're doing an examination, a review, or it's an agreed upon procedure. And so essentially, regardless of whether it's which of the three that you're doing, you're essentially taking the subject matter that management provides, and there is some sort of suitable criteria that is an overriding factor. And what the CPA does is they gather evidence in order to issue a report. Now, with an examination, what they're issuing is an opinion on the reliability of the subject matter. And so, what is the suitable criteria? Well, it depends on what the attestation service is. Certainly, if it's an audit of financial statements, the criteria is GAAP, generally accepted accounting principles. If it's an internal control audit, usually the standard is based upon standards established by a committee. The most popular standard for internal control is established by what they call COSO, which is the Council of Sponsoring Organizations. So you'll see that a lot when you deal with criteria for what is suitable internal control. So again, your levels of assurance are different depending on whether or not the engagement's an examination, a review, or agreed upon procedures. Now again, the first two generally involve financial statements, but again, the attestation services could also be related to internal control, and so that's what you get in these first two. For public companies, what you're getting is an examination of the financial statements with the criteria being GAAP, and they're also rendering an opinion on internal controls, and they're rendering an opinion concerning the effectiveness of internal controls. If they're just doing a review, it's not as stringent. There's limited assurance provided. there's a risk of moderate or a material misstatement, whereas for an audit and examination, the risk of material misstatement's fairly low. And when they're doing an examination, the auditors are actually rendering an opinion, whereas the wording of a review is they're not actually rendering an opinion. They're just saying that they're not aware of any material modifications that should be made. And notice the depths of the procedures. The gathering of evidence is much more in depth with an examination than it is with a review. And so here's an example of an audited financial statement using that prior diagram. The management prepares and submits financial statements, provides them to the CPA firm, and they take and they gather evidence to compare against those financial statements that are provided, and using the criteria, which is, in this case, GAAP, and based upon the comparison of the financial statements prepared by management to the evidence that the CPA is gathered, they issue a report on whether or not the financial statements are fairly representative of the company's financial position. And so when it is a financial statement audit, what they're trying to do is gather evidence and provide a high level of assurance that the statements are in accordance with GAAP. And so the audit involves searching and verifying accounting records and examining other documents, which we will get into the process of auditing as we go along. And so the evidence that's collected focuses on whether or not the financial statements are presented in accordance with GAAP. And so some examples of what would be done is to verify that the balance sheets contain all assets and liabilities, that the income statement has all the sales that occurred during the period, that they were recorded at the appropriate amounts, that recorded costs and expenses that are applicable to the period have been recorded, and that all expenses have been recognized. As far as financial statement amounts, they want to assure that the amounts are accurate and properly classified, and a big part of the financial statements, as you should know by now, are the notes. And so the notes to the financial statement should be informative and complete. So what creates this demand for audits? Well, think about this. If you have $100,000 to spend, to invest, you want to invest that money wisely. If you're going to invest it in the stock market, you want to invest it in companies that are going to provide the highest return. And so one of the things you would probably do, hopefully you would do, is you would review, you would analyze the companies that you're considering investing in. You would review and analyze their financial statements. Well, what if these financial statements that you're analyzing are not audited? What if they're just presented to you by the company? Well, the company has self-interest involved here in providing good financial information to you, not bad. So they want to be presented in the best light possible so that they can get your money invested in their company. And so essentially, because of this self-interest, you have to question the reliability of the information. And so that's where this intermediary, the CPA firm as auditor, comes into play. They are an independent, disinterested party to the possible transaction. And so a potential investor should have some assurance that the CPA firm is going to be independent in their opinion of whether or not the financial statements fairly represent the financial position of the company. And so audits lend credibility to information by reducing information risk. And information risk is the risk that information is materially misstated. And so financial statement misstatements arise due to sometimes accidental errors. Sometimes they could occur because of lack of knowledge of accounting principles. Maybe something got capitalized when it should have been expensed, or vice versa. Unintentional bias. Sometimes deliberate falsification happens. Now, the book talks about two types of risks, the first being business risk. This is the risk that, the company, the industry they're in, the management of the company, their decisions, the whole 9 yards, might end up with them failing in their business. Well, the audits don't directly address that issue. And so the only thing that the audit directly addresses is this thing called information risk. And that is the risk that the information used to assess business risk is not accurate. They go through the history of the attest function. Again, the attest function, the audit mainly. I'll not go through all of this, but basically what's occurred is that we've gone from, in the early 1900s, gone from auditors auditing every single transaction of a company to, businesses growing to such extent that what we have now is audits that use statistical or some sort of sampling of transactions. And so just realize that when an audit is done, the CPA firm is not looking at every transaction of a company. Think about how many transactions a company like General Electric has in an accounting year. Quite a few. And so it would take an enormous amount of time to audit the financial statements of GE if the auditors are required to audit every transaction. So what they've had to do is CPA firms, auditors have had to go to statistical sampling, and so they're sampling only a small percentage of certain transactions and certain accounts, certain things happening within an account. Now, there has been somewhat of a credibility crisis with all these different financial scandals, the biggest being Enron back in late 2001, early 2002. And so what has happened is there has been an increase in the focus on audit effectiveness. And because of both the Enron scandal as well as the WorldCom scandal, Congress created this law called the Sarbanes-Oxley Act. And so what the Sarbanes-Oxley Act requires, it's essentially a set of reforms that have toughened penalties for corporate fraud. It restricts accounting firms from doing, who are auditing companies, from doing certain other types of business, such as management consulting with that same audit client. It created this thing called the Public Company Accounting Oversight Board, PCAOB, to oversee the accounting profession, or at least the accounting profession of those CPA firms who audit public companies, publicly traded companies. The AICPA still regulates CPA firms who do not audit public companies. So what is a financial audit? Well, it covers balance sheet, income statement, statement of cash flows, notes, and all that other stuff that you see in a typical yearly financial report. And so the goal is to make sure that the financials are in conformity with the established criteria, which again is GAAP. Now, accountants who are not CPAs can do a lot of work that CPAs do. The one thing that non-CPAs can't do is perform financial statement audits. That must be done by a CPA. And of course, you have your different users. I mean, that's the whole. I mean, this is accounting 211 here, right? The primary users of financial statements are investors, bankers, government agencies, financial analysts. Now, there's other types of audits, such as an IRS audit. That's a compliance audit. You can have operational audits as well. A lot of that's done by internal auditors who work inside the company. So just realize that financial statement audit is a specialized type of audit, and it can only be done by a certified public accountant. You have different types of auditors. You have internal auditors that are employed by a company, and their main job is to make sure operational procedures are being followed within the company, to make sure internal controls are being followed within the company, to make sure that internal controls are effective within the company. And then you have government auditors as well as tax auditors who have a specialized type of job. And of course, if you become an internal auditor, you can be certified as a certified internal auditor, a CIA, which recognize your specialty in that area. Many CIAs are also CPAs, though. All right, let's talk a little bit about the AICPA. This stands for American Institute of Certified Public Accountants. What they do is they establish standards and rules to guide CPAs in their conduct. They provide continuing professional education. They provide research and publication. They self-regulate CPAs, or at least the ones who mainly the ones who don't audit public companies. And again, so much of the standard setting and regulation concerning CPA firms who audit public companies has been taken over by the PCAOB, which reports to the SEC. So you have in the AICPA hierarchy, the AICP Auditing Standards Board. These are official pronouncements on auditing matters for non-public companies. They also issue statement of auditing standards as well as statements on standards for attestation engagements. And so all these are guidance for CPAs in auditing of non-public companies. They also, the AICPA also issues publications. Some of the most popular ones in the profession are the Journal of Accountancy, as well as the Tax Advisor. They also have audit publications. They provide continuing professional education. If you're going to become a CPA, each state requires a certain amount of continuing professional education to stay up with current matters in the profession. And so the AICPA is one vehicle for obtaining CPE, as it's called, continuing professional education. It's also provided by state CPA societies, as well as the Board of Public Accountancy, I suppose. Again, the AICPA regulates individual CPAs. It provides a code of professional conduct that is often also used pretty closely tied to the rules provided by the PCAOB, as well as state societies of CPAs, as well as the Board of Public Accountancy, which is the group that allows you to take the CPA exam based upon your education and work experience. And the Board of Public Accountancy investigates any wrongdoing, and they're kind of you have to receive a license to become a CPA in a certain state, and if there's a wrongdoing alleged against you as a CPA, then they will open an investigation. So they're kind of the main body to worry about keeping your CPA license. And then these societies, both the AICPA and the each state CPA society, also has its own code that are very close to what the state's code of ethics have. And, you know, so bottom line is, if you are accused of wrongdoing, the state board is probably going to open a case against you or an inquiry against you. And if you belong to the state society, they're going to open an inquiry against you. And if you're also an AICPA member, they're going to open up a case against you. So, I mean, you could be getting it from all sides. The AICPA also regulates public accounting firms. And so what they do is, if you're willing to submit to a peer review, what will happen is one accounting firm will review another accounting firm to make sure that what they're doing is in compliance with what they call generally accepted auditing generally accepted auditing standards. So we'll talk about that later. If you want to become a CPA, you have to require for the CPA exam, and you have to have a certain, many states require a certain amount of work hours in the business before you can become a CPA, almost like an internship or something like that, or what do they call it? Apprenticeship. And so again, state boards issue the CPA certificates, and you have to have a certain amount of education as well as experience for most of these. Again, you should know this, that FASB, the Financial Accounting Standards Board, which is regulated or governed by or overseen by the Securities Exchange Commission, SEC, sets GAAP for entities other than federal, state, and local governments. And then you have these other parties as well. The PCAOB's rule is that they adopt auditing, attestation, quality control, ethics, and independence standards relating to the preparation of audit reports for SEC registrants. They oversee and discipline CPAs and CPA firms that audit public companies. Now, the SEC, Securities Exchange Commission, is an agency of the U.S. government, and they oversee responsibility for the PCAOB. So put another way is PCAOB reports to the SEC. And how Securities Exchange Commission is involved in this, and they want to make sure that companies that are listed on public stock exchanges are giving reliable financial information to the public that may invest in these companies. And so their job is to protect investors and the public by requiring full disclosure of financial information by these companies that are offering securities to the public. All right. Now, CPA firms also provide other types of professional services. Now, the attestation and insurance services that we talked about, certainly one of them. They provide tax services, they provide consulting, management consulting. They might provide accounting services, so they might actually come in and do the accounting for a company. Personal financial planning, litigation support's a big one. Fraud investigation, fraud auditing's a big one. And then we already talked about personal financial planning. CPA firms can be sole proprietorships if it's just one solo practitioner. Could be a couple of people or more together, working together as a partnership. Could be a professional corporation, could be a limited liability partnership or a limited liability company. There's different categories of public accounting firms. There's local, regional, national, big four, and there are now public accounting firms that are in what they call alternative practice structures, which is kind of an emerging topic that I encourage you to look at. Might be a good research topic even for one of you. Most CPA firms specialize in various industries, one or more. This helps firms be more effective at collecting and evaluating audit evidence and to provide client consulting services. And again, as far as the structure of CPA firms, especially national, you're going to have your staff auditors at the bottom. They'll be reporting to the senior auditors who report to managers who report to partners. And of course, the partners are the ones with ultimate responsibility over audits. One thing about auditing is it's fairly seasonal between December and April or May because most companies have a calendar year end. So you do a lot of work during that period. It's kind of like a meat grinder during that period. And then you have a lot of downtime after about May. So I mean, it's and then you got tax season on top of that you may do. So you may work heavy for 6 months and then basically charge your battery for another 6 months, or at least not work as hard, maybe more normal hours. And so sometimes firms allow you to bank hours for later vacation time, later in the year, that sort of thing. One of the things that you have to do, especially if you're a partner, is you have to find and maintain clients, obtain clients and maintain clients, keep them. And so one of the things you have to do that's very difficult is you have to maintain independence from the clients. And so that's kind of hard to do. We'll talk about several instances of scenarios where the independence will be questioned. All right, so that's it for Chapter 1.